How do some funds make money even when markets crash? Hedge funds promise absolute returns with secretive strategies, long-short trades, derivatives, leverage, and more. In this video, we're unpacking the myths and realities of hedge funds so you can decide if they're financial geniuses or just smoke and mirrors. Hedge funds are private investment pools run by professional managers who are given a wide and flexible toolkit to pursue absolute returns. That is, the aim is to make money across different market environments, not only when markets go up. Unlike traditional mutual funds, hedge funds can go long and short, use derivatives, and apply leverage to magnify carefully chosen bets. In a portfolio, they can play two core roles: diversify the risks of the classic stock and bond mix, and, when well designed, deliver streams of return that are less tied to market direction. Think of a hedge fund as a disciplined process and risk framework wrapped around a set of investable edges, all housed in a private partnership. What is a hedge fund? A hedge fund is a private, pooled investment vehicle. It is run by an investment manager, the general partner, for accredited or qualified investors, the limited partners. The promise to these investors is risk-adjusted, market-independent returns, sometimes called alpha, which are returns that cannot be fully explained by broad market exposure. The mandate is deliberately broad compared with mutual funds. Managers can short securities, use leverage, and trade derivatives to hedge risks or express views with precision. In exchange for this flexibility, investors accept limited liquidity, higher fees, and a more sophisticated risk control environment. The bargain is clear: more tools, tighter controls, and the pursuit of returns that are driven by skill rather than by simply riding the market. How hedge funds work: lifecycle. The lifecycle begins with fundraising. The manager sets out the strategy, risk limits, and economic terms in documents such as the Private Placement Memorandum and the Limited Partnership Agreement. These spell out what the fund will and won't do, the fees, the liquidity schedule, and governance. Once capital is committed, the firm deploys capital according to its mandate, whether that is equity, long-short, global macro, relative value, credit, or otherwise. The risk and operations engine runs daily. Exposure checks, limit monitoring, reconciliations, and independent monthly net asset value calculations by the administrator. Performance is distributed monthly or quarterly. There's no fixed exit clock like private equity. Investors enter and redeem subject to notice periods, lockups, and gates defined in the documents. As the fund gathers assets, the manager practices capacity management, using soft or hard closes, so the strategy does not become diluted by size. The discipline here protects the edge that generated results in the first place. Key participants and infrastructure. At the center sits the investment manager, the CIO and portfolio managers, supported by analysts, traders, risk managers, quants, operations, and compliance. The investors, LPs, are typically pensions, endowments, sovereign wealth funds, family offices, and high net worth individuals. A critical partner is the prime broker, which provides financing, facilitates stock borrow and locate for shorts, and offers leverage and collateral management, often with rehypothecation rights defined in the agreements. The fund administrator independently calculates NAV and handles investor services. The custodian safeguards assets. And the auditor performs the annual audit. On the system side, the firm runs an order management system for trading, a portfolio management system for positions and P&L, and a risk management system for real-time exposure, factor tilts, and stress testing. Legal and compliance functions oversee AML, KYC checks, and regulatory reporting, such as Form PF in the U.S. or PRIIPs, KID, in applicable jurisdictions. Strategy landscape. Hedge funds come in families of strategies, each with distinct edges and risks. Equity long-short ranges from directional funds that lean long or short to market-neutral funds that balance exposures to isolate stock-picking skill. Many are factor-aware or sector specialist. Event-driven funds trade corporate actions, merger arbitrage, special situations, spin-offs, and restructurings, seeking to harvest the spread between today's price and a defined event outcome. Relative value strategies focus on pricing relationships, fixed income arbitrage across bonds, swaps, and futures. Convertible arbitrage, pairing a convertible bond with a short in the underlying equity. Volatility arbitrage and statistical arbitrage that exploit small, repeatable mispricings. Global macro managers, discretionary or systematic, trade rates, FX, equities, investments, and commodities based on macroeconomic views or models. Managed futures, CTAs, typically run trend following or time series momentum across many liquid futures, often providing crisis alpha when traditional assets falter. Distressed credit strategies invest in stressed or distressed debt or run capital structure arbitrage across a single issuer securities. Quant multi-strategy funds use machine learning, alt data, and signal libraries, multi-PM, pod. Platforms allocate capital across many sleeves under a single risk umbrella. Finally, emerging alternative areas, such as crypto funds and DeFi market making, where permitted, apply the same risk discipline to new markets with unique infrastructure and regulatory needs. Fund structure and terms. Most hedge funds are LP-GP partnerships, often arranged as feeder and master feeder structures for tax and investor geography. Fees are frequently quoted as 2 and 20. A management fee around 2% and a performance fee around 20%, though actual terms vary by strategy and scale. 3 mechanics matter most to investors. The high water mark ensures the manager earns a performance fee only on new profits, never charging again for recovered losses. A hurdle rate requires returns above a threshold before any performance fee accrues. And the crystallization period defines how often performance fees are actually realized. Liquidity is tailored to the portfolio. Monthly or quarterly dealing, initial lockups to stabilize capital, gates to slow redemptions in stress, and side pockets for truly illiquid positions. Large investors sometimes negotiate side letters for capacity, fee breaks, or added transparency, always within regulatory boundaries and disclosed as required. Sources of edge and tooling. The hedge fund toolkit is broad. Leverage and shorting, secured through prime financing, allow managers to express views on both winners and losers, while derivatives hedge unwanted risks or provide clean exposure to a theme. Edge often starts with research, alternative data, expert networks, channel checks, and quant signals can reveal patterns before they show up in earnings. A repeatable process, from idea generation to sizing and risk review, keeps the edge consistent. PM analyst workflows, checklists, and PM calibration, how a portfolio manager sizes and resizes positions, translate ideas into controlled bets. The technology stack matters. Clean data pipelines, robust backtesting, smart execution algorithms, and transaction cost analysis to minimize slippage. Finally, culture is a tool. Risk discipline, honest postmortems, and rapid feedback loops compound small advantages into durable performance. How hedge funds manage risk. Risk is viewed from multiple angles. Gross exposure sums all longs and shorts. Net exposure measures the directional lean. Managers track beta to markets, factor tilts like value or momentum, and sector or country caps to avoid concentration. They set limits on position size, use stop losses and portfolio drawdown limits, and run value at risk, VAR, and expected shortfall, ES, to quantify potential losses. Liquidity analysis, time to liquidate, market depth, and stress liquidity haircuts asks how positions behave if volumes thin or spreads widen. Counterparty risk is monitored through prime broker concentration, rehypothecation terms, and collateral management. Model risk is addressed by guarding against overfitting, acknowledging regime shifts, and testing correlation breakdowns. And operational risk, key person exposure, trade breaks, cyber threats, and compliance gets equal attention because operational failures can erase investment gains. Key metrics and reporting. Investors receive monthly NAV and a package of analytics. For return, they look at annualized growth, sometimes CAGR, and in certain contexts, IRR, for cash flow-based vehicles. For risk-adjusted outcomes, the Sharpe ratio measures excess return per unit of volatility. The Sortino ratio focuses on downside volatility, and the information ratio compares alpha to tracking error. Drawdown statistics, maximum drawdown, recovery time, and the Kalmar ratio make the experience of losses tangible. Factor and alpha diagnostics decompose performance into market beta, style factors, and residual alpha, while hit ratio and payoff asymmetry describe the quality of bets. Attribution separates allocation, selection, and timing effects, often down to sleeve or PM level on multi-manager platforms. Exposure dashboards summarize net and gross exposure, betas and factors, and a liquidity ladder shows how quickly the book can be converted to cash under normal and stressed assumptions. Industry landscape, global and India. Globally, the ecosystem ranges from multi-strategy pod platforms that allocate capital across many independent teams to specialist boutiques and large macro or CTA firms. Current trends include the expansion of the pod model, aggressive hiring in data science, and fee compression where capacity is abundant and alpha is scarce. Allocators, pensions, endowments, sovereigns, and funds of funds have raised the bar on operational due diligence. In India, hedge fund-like strategies typically operate within alternative investment fund Category 3 structures. Long-short equity and quant funds are growing, but the precise design of strategies is shaped by local rules around shorting, derivatives, and liquidity. As the market deepens, managers are tailoring playbooks to Indian microstructure while borrowing global best practices in risk, operations, and reporting. Why investors use hedge funds? Investors use hedge funds for diversification against the traditional 60-40 portfolio. For downside protection and potential crisis alpha, particularly from managed futures, and for access to niche risk premia and genuine alpha streams not packaged in index products. In practice, hedge funds can act as a risk mitigator, smoothing the ride, or as a return enhancer, adding skill-based gains on top of core exposures. The right role depends on the strategy mix and the investor's objectives. Criticisms and challenges. The industry faces fair critiques. Fees can overwhelm benefits in low alpha regimes. Crowding, many funds chasing the same signals, can lead to correlated drawdowns. Liquidity mismatches arise when managers hold illiquid positions but offer frequent redemptions. Limited transparency can feel opaque next to mutual funds or ETFs, and under pressure, some managers drift from their stated style. Finally, key person risk is real. The edge may sit with a few individuals whose departures can degrade outcomes. Strong governance and honest communication are the antidotes. Case studies, wins, and blow-ups. There are genuine wins, notably quant trend strategies that have historically helped during crises, and managers who protect capacity and stick to repeatable edges. And there are blow-ups that teach hard lessons. LTCM, 1998, showed how leverage and correlation shocks can be fatal. Amaranth, 2006, illustrated the danger of concentrated natural gas bets. And Archegos, 2021, a family office but relevant, exposed prime broker and counterparty vulnerabilities. The composite lesson is clear. Keep leverage prudent, respect liquidity, cap concentration, and diversify counterparties, supported by a risk culture empowered to stop trades that violate the playbook. How to diligence a hedge fund, allocator lens. Begin with strategy clarity. What is the edge? Why does it exist? And where is capacity capped to preserve it? Examine the risk framework, limits, stress tests, and the downside playbook for drawdowns. Evaluate team and culture, how incentives align with investors, turnover patterns, and how decisions are made and reviewed. Confirm operational robustness, independent admin and audit, cybersecurity, trade surveillance, and a clean compliance history. Check terms alignment, fees, high water mark, hurdles, liquidity, gates, and side pockets. Finally, test portfolio fit, correlations to your holdings, whether the fund serves as a hedge or a return engine, and how sensitive it is to the regimes you care about. Closing, hedge funds are toolkits, not magic boxes. Outcomes are driven by edge times discipline times risk control. The best funds articulate a clear edge, run a robust process, align terms with investors, and manage capacity so that alpha is not diluted. The goal is repeatability. Protect the downside so the upside can compound. Bolt and use this way. Hedge funds can diversify portfolios, buffer stress, and add meaningful, skill-driven returns over time. Thanks for tuning in. If you enjoyed this video, you'll love the other in-depth guides we've created for you. Be sure to check them out next. If this content helped you, please like, share it with a friend, and subscribe to CandiMentor so you never miss an update. We've also built a world-class career platform at CandiMentor.com, packed with tools and resources to level up your skills. Visit us today and see how we can support your journey.